Want to know how to leap from your first rental to $2 billion in real estate? Stick around. These are the secrets most investors never hear. All this and more coming right now. Here we go. Lane, welcome to the show, man.
Hey, thanks for having me. Hello, everybody.
Yeah, it's good to have you, brother. Let's jump right into it. Most people think financial freedom is decades away. Now, you've built multi-million-dollar passive income streams in a fraction of that time. Before we get into the details, take me back. What was the first critical shift that you would say someone needs to make to even get on that accelerated path?
I mean, it seems esoteric, right? Because we've all kind of read the book Rich Dad, Poor Dad. But yeah, you do have to just buy assets. But the key there is you need to have capital to buy assets. You know, I don't believe in the no money down, free property type of thing. I mean, when I first started, I would just buy little rental properties, 20% down. And it did take a while to build that initial capital.
Yeah. And what's some of the things? So did you self-fund it or how did you get going on getting that initial capital to build you into what you've done now?
Yeah. So in a previous life, I used to be an engineer. Didn't really like the job. I had a good pay right out of college and, kind of grew up in one of these families where we're taught to be frugal with our money. Never buy soft drinks when you go to a restaurant because that's just a waste of money because they give you free water. That's where I think almost six figures pretty much right out of college. And I was able to save maybe 30, 40 grand of it right off the bat. So fast forward a couple of years, 2009, bought my first house to live in because again, that's what we're all brainwashed to do, buy a house to live in. And, just a guy in his 20s, big house to himself in Seattle, Washington. And the magical thing there was I was traveling all over for work as a construction supervisor, never home. Well, why don't I just rent this thing out? And that was when I went on this magic carpet ride and became a landlord. And I guess the rest is history, right?
Yeah, awesome, man. So you've built it up. Now, if people want to take an active role in doing deals, getting capital, even if it's your own or investors, that's a whole show on its own. But what are some of those tactical things that people can do just to start moving? If you remember those early days, maybe walk me through some of those tactics that you can do and maybe share that wisdom.
Yeah, I think the basics are like, what I teach on the first floor of the wealth elevator. Just real basic stuff like keep a budget. If you're unable to control your income and expenses and have a net savings at the end of the day, you're never going to get the capital to invest. And the nice thing about real estate, for all the things we all know, but the bad thing about real estate is you need capital to play. And you can't just use $5,000, $10,000 to buy a piece of real estate like you can crypto or stocks, bonds, mutual funds. You need a more substantial amount of money. When I first started, I would, buy my house to live in. Eventually, I would buy these little turnkey rental properties out in Birmingham, Atlanta, Indianapolis for about $80,000, $100,000 each. 20% down payment on those. I needed 20, 25 grand to get into one of those things. But that was the name of the game. I think when you're on that first floor of the wealth elevators, get out of debt by saving money, putting it to assets. And then, I tell people like, look, if you're in credit card debt or your income is less than 50 grand, 100 grand, I'm probably not the guy to follow.
Got it. And, when you're getting into real estate, like we have a lot of investment bankers, family offices, stuff like that, and people who aspire to be as well. Can you talk a little bit about your discovery of Fannie and Freddie and how that ties into doing deals and really encapsulate a little bit of working with debt and some of the organizations that are tied to that? How did that play into you moving from your first single family to $2 billion in assets?
Yeah. So two different worlds, essentially, right? Your residential world where you're buying 1 to 4 units. From 2009 to 2015, I had about 11 rental properties, and I essentially maxed out as many Fannie Mae, Freddie Mac properties that one could get in their own name. I don't know if it's changed. I think it might be the same, but back then people would always talk about getting 10 in their name, 10 in their spouse's name, getting 20. Obviously with that many rental properties, it becomes a headache. And especially being an accredited investor, with a higher net worth, lower propensity for, time sucks and liability, that was why I made the natural transition away from single family homes and went into more multifamily commercial real estate. And that was kind of where, I kind of kissed the world of commercial or residential lending with Fannie Mae, Freddie Mac, 1 to 4 units, and into the commercial world, where more and more the asset is backed by the asset. But one of the big barriers to entry to, buying a 100-unit apartment complex, for example, is this lending, right? Fannie Mae, Freddie Mac, they have pretty strict lending requirements from the sponsor team or the loan guarantor team, where your loan guarantors, the people signing on the debt, or key principles is another word for this, need to have the net worth greater than or equal to the loan, right? So if your net worth was 20 million and mine was 5, best thing that you and I could qualify together for was $25 million. So that's how that world kind of works. And then the big part of this world is you also need to have the experience, which is unfortunately the chicken and the egg quantum that many people might be aware of right now listening or may face in the future, where if you've never done 100 or 200 unit apartment complex signed on the debt, it doesn't matter if you're LP in the deal. Nobody cares about that. That's not experience. But you had to sign on the debt and get your Fannie Mae Freddie Mac card, right? That's a big barrier to entry here.
Brilliant. So there's a lot to learn when jumping into that and expanding, and you've expanded on that accelerated track, man. So I love these dichotomy questions. So I think I know the answer, but for the benefit of those listening to us, would you rather spend 40 years climbing a corporate ladder or 4 years building passive income streams that let you walk away? I think I know the answer to that, but really what I'm asking is, how did you discover that the second option was not only possible, but repeatable for everyone else?
Yeah, I know what room I'm in, right? So we all know what the answer is going to be. But, to dig in a little bit more into that question, unfortunately, it's not always black and white or binary, like you mentioned. There's always, at what risk level you're willing to take on. Yeah, and maybe this somewhat justifies the way that my parents did things, or the long, professional W-2 path that a lot of people are on. If you go down that path, it's going to be long and somewhat hard, but it is reliable, and we kind of know what's going to happen, right? Like if I would have just bought my house to live in, paid it off, maybe bought a couple rental properties, right? Eventually give that to my kids when I pass away, that would probably be a good life, but that would get in the way of a great life. And certainly I wouldn't be living up to my utmost potential. Like a lot of people that may or may not be your value, right? To maximize every single resource or God-given talent you're given. But I kind of reached a point of somewhat financial freedom very early in my, I've been investing since my early 20s, and a big chunk of that time, I was, I didn't talk about this part of the story, but I was sort of homeless. Not like these Reg to Riches stories, but I was living in the company. I was working as an engineer for a company that would put me in hotels. So for like 3-4 years, I didn't have any rent payments or any, mortgage essentially. My tenants are paying down my mortgages for me. So I was able to sock away like 6 figures for several years there. That really, really put me ahead, especially in the beginning. That's a pivotal time for such a liquidity injection like that to then invest and put into the wheel. For me, it was like I got to 11 single family homes in 2015. I think I was maybe 29, 30 at the time. And then I was like, well, what's next? Well, what kind of logical fella does not think like, well, let's go into more single family homes. Oh, that's multifamily, right? So that's where I started to discover this world of multifamily investing. And then, like, as you mentioned, the lending standards of Fannie Mae, Freddie Mac, and then, playing the role of asset manager and kind of getting more ingrained in the syndication and private placement world.
Brilliant. One of the things you told me another time, we've spoken a couple of times here, but you said what you like to do in the early days is almost think about at what point in this market, this is the early days, what point of this market does the world cave in, and where is that sinkhole? And I'm curious from that. I know the answer to that, but what did you find? Where is the place that just sucks in everybody into this endless pit of woe? What have you found, and how did you turn that around?
Yeah, at the end of the day, these are investments and there is always risk associated. I do think you get a much better risk-adjusted return when you kind of do things on your own and kind of go off the beaten path and, get into what they call alternative investments for this alternative world. But I think very early on, I caught on, just buying little single family homes, you underwrite the deal. It's very elementary, right? You have your income where you might make $1,000 a month in rents, and $100 goes to property managers. Another $100 goes to taxes. Another $100 goes to insurance, and a few others I'm missing out, right? And CapEx, of course, that comes and bites you every so often. But you're left with a surplus there. And it's nice to have surplus because we all know that things happen and they will. And that's at that point that eats into your you think about like a tooth enamel, right? It eats into your buffer. So in that instance, right, like over many, many years, I kind of got maybe desensitized to it a little bit, right? And also, who doesn't like to stack money up? And now you get a little bit more of a reserve cushion, right, to weather those ups and downs. More importantly, there were a few times where tenants would just move out because they ran on tough times and they just trashed the property. I can probably think of a few times where the repair bill is like 20 grand, 25 grand. And that doesn't even include the few months that the property is down. And at that point, that's why you have reserves and buffer to pay for that stuff. But at the end of the day, I mean, dollars and currency is sort of what, are you positive or negative in the long run, high level?
So it sounds like having reserves are one of those sinkholes, and then underwriting. Those two seem to be those two areas that investors or asset managers really need to pay attention to. Is that right?
Yeah. And then we'll get more advanced in that, right? Because, we've established these esoteric ideas, but like, what does that really mean? Now, when you're getting it more into like an apartment deal, for example, there's many, many things on the underwriting sheet that will get you. And, what we do is we look at a lot of deals out there, and we've operated many, many properties on our own. And we have sort of insider knowledge on what true comparables are, what rents are out there, price per square foot, for example. And we also know what these properties should operate at, what expense ratio they're on it, because, we can baseline it with our own assets. And we also have our third-party property management teams to baseline within their portfolio too. And at that point, we have good data. At that point, it's just like, well, what's the risk tolerance that we're willing to take on? Right? Like, how bad can things get before we start to lose money? Some people call this sensitivity analysis. Unfortunately, there's, a handful of, there's many, many factors in it. But, I always say 80-20 analysis, like what are the top ones that are going to get you? And, when we look at deals, it's what is the reversion cap rate in comparison to the entrance cap rate? What is the full occupancy assumed? Is there any economic vacancy assumed? And, what are the rent escalators assumed? And, that it are typically the three biggest drivers of any underwriting specialist in the apartment world. And, that also kind of flows to any deal you look at. Like, there's always a few cells in the spreadsheet that really move the needle that, are sometimes notoriously fudged by operators. And as an investor, it's your job to understand what are the major factors and to apply the normal assumptions to normalize the underwriting projections.
So what would you say then that you said some operators, there's some areas that they fudge, we'll say, to put it lightly. What are some of those areas? Maybe you can give a cautionary tale or some helpful advice when there are investors who are proposed a deal. Are there any areas that they should really dig in from your experience just to be the anti-number fudging detective that they are?
First one, the simplest one is like, if you look at the underwriting, what is the assumed full occupancy of the asset? Properties never run 100% occupied. Typically, you want to see 92%, 93% at most, right? You could run the asset at 100% occupancy, and that's great. But that typically, if you're pushing for optimal rents, the highest rents, you don't want to sell out all your seats. So therefore, you want to see the underwriting reflect this. And then you also want to see maybe 3%, 4% in terms of, people, it might be occupied, but people may not be paying. More early on in our days, we would do more Class C properties, so rougher tenant profile. This would be in a place like Fort Worth, Texas, right? Some of the rougher areas. One of the properties that we're very successful on, we are only able to get at best maybe 80% economic vacancy on. So if you have 100 units, 20% of the people are deadbeats or a combination of partial pays. That's par for the course, sometimes in these Class C neighborhoods. Your Class A may run as high as, 5%, 10% too. Especially when you're going through the restabilization period, which is any good value add project goes through, there's always some hair on the deal. And then you're going through the rough patch as you're kicking out the bad tenants and bringing in the new regime, which also kind of ties hand in hand with, improving the community too. But yeah, something like that can throw the numbers off pretty drastically. Like if something is projecting 100% return in 5 years, normalizing that may drop it down to 80%, like a dropping of 20%. I think that's, people may not understand the different aspects of what all these terms mean. I think that's a very understandable one. But the big one, I call it cap rate gate, is the reversion cap rate. Normally, for good underwriting, you want to assume that you're selling it into a worse off market, a softer market. So you increase the reversion cap rate, which in turn means you're getting a worse sales price at the end. So you want to increase the reversion cap rate to assume that you're selling into a softer market. So maybe you increase the cap rate by 0.5% at the exit. So for example, the assets for Class B in Dallas may be trading for, I'm just throwing these numbers out there. Today might be like 5, but you use a 5.5 reversion cap rate on the exit. Now, some institutional operators may assume that they're selling it. They enter it at 5 and they're sell it at 5. Could happen. I would just rather be more conservative and assuming and just running the numbers at the 5.5, right? So sometimes we see operators, will use an even lower reversion cap rate. So 4.5, we'll just, won't think much of it. We'll just put it back to what it should be and then run our numbers on our own. Fudging of 0.5% seems like small numbers, but I've seen that play with the numbers as like maybe 20% one way or the other. So if you were projected to 100% return your money, that may mean that when you normalize it and the deal actually goes through, then it runs through at like 75% return. So that's a big lever right there.
Brilliant. So looking at those cap rates and occupancy rates tends to be a button that might get very aggressively switched on by people pitching deals. And so I think those are, from what you're saying, those are some key areas to explore on when you're reviewing an investment.
Yeah, it's a starting point. I think unfortunately for a lot of retail deals out there, when investors get the decks, there's no talk about what is the reversion cap rate, what is the cap rate of the market. I think that's where we kind of put an operator hat on. And, we know a lot of this, we're just asking what was in the underwriting. And we but at the end of the day, I think you need to get the P&Ls and the rent rolls and the raw financials to run it yourself.
Brilliant. So you mentioned before that you've been an engineer. So when you first started investing, what were some of those mindset shifts that had to happen, or some that you had to unlearn? What were some of those things that were helpful or unhelpful when you started out?
Yeah, starting out, I always just had the idea that I was just going to buy rental properties and just quietly work my day job. Throughout my career, I initially was in the public sector working for a very stressful Fortune 50 company. I suppose that's where I learned a lot about leadership, blah, 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 but that was also where I made a lot of money. My salary was highest at that point. And I had this idea that I would replace my income with all these rental properties. And then, I would just at some point retire, right? Today I tell our folks, if you can hit a net worth of 4 to 5 million, you should be able to get that, the people hear about the 4% withdrawal number, you should be able to hit like $10,000-$15,000 of passive income a year, investing in easy peasy stuff like life insurance or T-bills, right? Low risk, low return type of stuff. I'm not saying you would, but just as what's in the realm of possibility, right? So the idea is if you can just accumulate to that point, you can essentially get yourself financially independent at that point. Now, something changed for me, when I started to get into multifamily syndication, started to become the operator, get more involved in the general partnership side of these deals. And then I kind of realized that, hey, there's something to this here. When I know you and I were kind of talking about this behind stage that, it wasn't all sunshine and rainbows. When you're working with operators under, $500 million of assets, it's a little hit and miss. They're newbies. Somebody with $50 million, $100 million of past acquisitions isn't very much in the real estate world. May mean a huge thing in private equity or angel investing, but, in real estate, you typically add a couple of zeros onto everything.
Yeah. It's microscopic for sure.
Yeah. But that's sort of where I realized that, hey, I could turn this into my new career or my vocation, right? Finding deals, investing, and operating. And that was kind of where I got out of my head of like, I'm just going to do the status quo, the W-2 engineering job, and then kind of hide and not talk about finances to my coworkers because then I would be embarrassed or have to pick up the bar tab every time.
Yeah, got it. Now, people are expanding into real estate or maybe different sectors or whatever that might be. A thing that I like to ask a lot of people on the show is walk me through your first deal. What did it cost? How did you find it? How did you finance it? What did it teach you? Walk me through that first deal.
Yeah, so the first one, it was a very small deal, Class C. That was all we were able to have access to, right? Because we typically will go after more stabilized properties. So that is defined as 90% occupied or better. Don't believe what the gurus tell you. Like if somebody owns an apartment of at least 50 units, they're not going to sell it to you because you sent them a stupid yellow letter. These guys are not idiots. They're going to go through a broker to sell the assets and get the fair market price from the market overall. So we had to kind of start at the bottom, buying these Class C assets, and obviously smaller. So I think the deal size was like $3 million. All I remember vividly was that we needed to raise about $1 million to get that deal done. And boy, was that difficult.
What made it difficult? I'm curious.
No track record, no investors. Also, the numbers were hard to make work. I mean, the rents, there was a big disparity between what the market rents were and especially once we renovated it. But the problem was in the P&L, when you have such a small unit like that, like we didn't have full-time property management on staff. We weren't able to tap into commercial property managers where you pay salary plus, 4% up monthly rents. We were in the no man's land where we had to use a residential property manager where, they take sometimes like half or the full first month's rent, and that, that's just one aspect of why you get into larger commercial deals because of the economies of scale, multiple units per one roof, for example. But yeah, that property just wasn't able to get that economies of scale with that one. And it made the expense ratios on it difficult. But, that's whether a deal cash flows or not, is independent, sometimes independent if you are going to have a successful deal, right? Like think of a house flip. House flip, you make no money during the flip, right? But you can sell it at the end. Right. In a way, that's what we do is we kind of do these slow flips where we just let tenants naturally turn in and out over time. A few years go by, you can typically get through most of all the tenants and bump rents and renovate. Ideally, this is prior 2020. I think it was like 2018-ish. Back then, things were a lot cheaper. So you could have the best of both worlds in cash flow and have the pop appreciation when you value add and force appreciate it. Nowadays, everything's just getting more and more difficult.
Especially raising capital, that can be a challenge right now. And what I'm seeing is it's harder to do smaller deals. Which gives me the theory that a lot of capital is being held by institutional investors. Could be wrong, and leave your comments below if I'm misled. But seems like the larger deals are the ones that are getting funded, and sometimes these smaller deals, unless you got a good personal network, that might be better. But smaller deals right now are a bit of a challenge. So I always say times your whatever your number it is. Let's say it's $1 million, times it by 2, and add a 0. So it shifts your thinking and walking up to that. Now that is a different story. So raising the capital is one thing, but actually being able to find and manage and exit deals like that, that's an entirely different one. Now, one of the things that doesn't really show up directly in the line item on your P&L is partnerships. What have you found? Maybe you've had all good ones. Maybe you've had all bad ones. Maybe you've a blend of both like me. What have you found to be helpful when building those partnerships and how that helps to close deals?
Yeah, I mean, it's a blend, like you said, right? Unfortunately, we've learned through attrition, like the people that stick around, you go through ups and downs, and the people that you are still around, that you work with, have good integrity, that do what they say they're going to do, is, the people you stick around with. I think this is where it's difficult. And maybe it's just like romantic partners too, right? You don't know how things are at, like the first date, or even first deal, everything's great, right? There's great energy, but you don't really learn how people are until there's some adversity, or as simple as like, hey, you got to sit down at a computer and do a draw request and, for a couple hours and crank out these attachments, right? To these reimbursements, right? Like sometimes people you thought you knew well just can't do it. And at that point, I don't really have a good criteria. I do think that is a little bit more randomized, but yeah, I like to see partners with Fortune 50 or Fortune 500 corporate background would be nice, right? At least at director level. Surely holding down a job for 5 to 10 years, right, is all I could ask for. Net worth, at least an accredited investor, right? Not saying that, they couldn't have got parents giving it to them, right? But, most operators are typically first generation multimillionaires. If not, then they're more on a passive role, more of an institutional investor role by the time they hit their second, third generation. Look, I went to the ringer, had some good ones, had some bad ones. And the ones that I got now, like the relationships are even tighter. Yeah, you and I were talking about this earlier. Like a lot of people run through this problem of they think they have to partner up. And I think you do, right? Especially when you're taking down a big big deal.
Yeah.
Not it's a team sport, and a lot of people will they feel like they need the motivation or the camaraderie of another person there, and so just on that accord alone, they go out and find a partner. But they don't. Two things: they don't know what they're good at. Like they don't know their own affinities, even if they've worked a corporate background. Like some of my partners, they've maybe been in sales, but now they're on the operation side, and then vice versa, right? You don't know what your affinity is in terms of your own skill sets. And also you don't know if your skill sets and affinities are complementary to that of the partner. Like you don't want a situation where both y'all do the same exact thing. That's just, you don't need one of you guys.
Mm-hmm. Yeah. One of the things that I've found, if I can chime in on that, because I'm like you, I've had a mixed blend. Some are phenomenal and they're still in my life, and some didn't work out, just different priorities, we'll say. Couple of things. A framework that I utilize, and I've used it a lot, I call it the UVE framework. It stands for umpires, vampires, and empires. And so umpires are people that keep you on the straight and narrow. They may not be like you, like a wild man doing deals and all that, but they're really good, and they make sure they know your goal. They stand up when you win. They're just like your best friend. They may not be on the same path, but they just want to see you win, and they're not going to let you. They're going to call out your BS. If you're tired and you want to do something stupid, they'll call you out. Now, that's also lawyers, accountants, all that stuff. Vampires needs no introduction. Anything you're doing or people or partners that just drain you, probably not a good fit for a partner or someone in your company at all. And then empire builders are those people who not only can they do the job, but they want to. This is part of their goal. They really don't. Like they are terrified of dying in a cubicle after 40 years of and just worked for someone else's goals. And so you have these empire builders. That's number one. But more specific, so that's more of an energetic framework. But specifically, if I could chime in, since we're on the topic of picking partners and avoiding some that may not take you where you want to go, I've boiled it down to really 3 distinct roles. And this is more on the investing side, but it's the 3 roles that I think any good deal would need is a capital raiser, someone who knows the mark. They love it. They don't mind going to dinners and hustling and flying around the world and meeting and turning dinners into dynasties. Great. You need a capital raiser. Second one is a fund manager or an ops person, someone who's comfortable in the ops. They have experience in the operations, be it real estate, venture capital, private equity, whatever that is. You need an ops person. And then finally, you just need an expert investor, someone who you give them a stack of deals, they'll shortlist that stuff fast. And so maybe you fit into one of those. This is just my framework, maybe not yours, but you have a framework where you say, okay, like for me, I love being the capital raiser, right? I love going out there. I don't mind getting rejected and kicked in the teeth and getting back up and trying one more time. I think that's fun. Some people are like, that is a total nightmare. They would never in a million years want to do that, right? Just keep me in the office, put me behind a computer. I'm happy to run this whole thing. So having a capital raiser, an expert investor, and an actual operator, those are some key roles. And then once you know the roles, how you fit into those roles, then you can start seasoning it with the energetic framework to say, is this person an umpire? Are they a vampire? Or are they trying to build an empire? And if they're 2 at least of those 3, then maybe we can partner up. So that's kind of that cross-reference matrix that I put together and really analyze any partnerships. Anything you can add to that?
That last one kind of sounds like the analyzer, the underwriter. I would probably say that's the least important of them all. Like that's the one that, we kind of kicked to the curb and hired out first, right? Because it's not unique. And, people may be in different circles, but you always find like a geek that likes to play in the numbers that can't talk to people, right? Like it's very commodity.
Yeah, for sure.
Kind of a person. The operator is important. And then the capital raiser, I would expand that to biz dev too, right? Because sometimes, you're working with brokers to find deals, or maybe you have some colleagues that you just met, some competitors maybe, and they are passing on a project, or, the biz dev is an important one, but the skill sets on each of those 3 are very mutually exclusive. That's the word, right? Like one's more of an introverted analytical type. One's more of an extroverted type. One's more focused project management type. Vampires, I get you need to figure out what that is, but I don't think you're going to figure out what that is in the beginning. I mean, and then that's where, we've been through fires, right? Like commercial real estate has been absolutely up and down the last several years. The analogy I use is like, house catches on fire. Until the house catches on fire, you don't know if a person is going to run in there and, start saving the things and people inside. They're going to freeze, or they're going to run the opposite direction. I know you're right. You're right. Like in the beginning, you can tell which of those 3 are, but you don't know what they're going to do when the fire happens.
That's right. Yeah. And so pricing that in and making sure and just being committed to that framework is to say, I don't want to partner with people that drain me. I want to partner with people that keep me on the path, help me to prevent this crazy train from rolling off the tracks, but also people who are trying to build their own empire. They have the hunger, the fire, whatever it is you want to call it. These are people who not only do they have the skills, but the temperament, the drive, the goals, the vision of their life. And then we can utilize that in my firm, and yours might be different. Now we can utilize that to say, okay, maybe this guy might be a good fit. We'll still price things in, probation periods, all that stuff, plan out an easy exit just in case. Because like we said, you don't know. You don't know until the thing's on fire, how are people going to react? This is the one rule that I have. Well, the main rule is to say, if there's ever an issue with a partner, just remember it's me and you versus the problem, not you versus me. And as long as we maintain that to say, if the house is on fire, how do we come together to put it out rather than arguing who started it? I'm just using that as an example.
If the guy is still there, right? And he ran away.
If he hasn't run away. And so it's just saying like, hey, if you want to lock arms and really figure this out, there's going to be great times, maybe a few fires we got to put out. But as long as you maintain that unity and you've got those skills, then I think we've got a good partnership. So we're going really deep on partnership models and things that we do to really vet that out. So,
well, let's go deeper here. I got a couple other things.
I'd love to hear it.
One mistake I see people make is that they need motivation. Right? These are the guys who go to your Tony Robbins seminars because they just need motivation. They can't motivate themselves. So they find a cheerleader partner. We don't know if they're vampire umpire. I guess they'd be a kind of a cheerleader too, right? But they just get somebody just to get somebody, right? This is the person who gets into a relationship because they're lonely, romantic relationship.
Yeah, what could go wrong?
Yeah, I don't know. I guess there's people listening are probably, maybe we've all been guilty of it, right? Maybe myself included, right? So we all know what that is. But, that's, if you haven't yet jumped into bed with a partner on the business side, maybe take a pause a little bit because it's really hard to undo these things once you're in it. And then the second thing about partnerships, just going back to, you just don't know how they're going to jive with you. And then there needs to be a personality mix and also skill set mix. I mean, we just did this. We had a coach give this training to us recently where I think it was Stephen Covey, like it's like 6 gears, something like that. But like each partner needs to take, this is it kind of, people call these like personality tests, but it's just more how you tackle problems and issues or new concepts. But, in those gears, like there's always one person that is the quick start. They have a lot of ideas, some good ones, some really bad ones that waste a lot of time. And then it goes to the second gear, you're a judgmental person, right? They say, no, that's a waste of time. Or to basically somebody who does the 80-20. I mean, that's what I do. I'm kind of that person in our group, right? And then the next is your implementer, creates a system. And then I'm missing a gear in here, maybe because I lack that gear myself. But I know that the last gear is like, at some point you have to hand it off to a team and motivate your team. So it's the galvanizer with people. So like there's so many ways to layer on top of, picking a partner. But then I think once you get to that level, you're kind of, just like a old married couple who's been married for 10 years or more, right? You got to figure out what works.
Yeah, that's right. A big thing that I like to look at are forcing functions and force multipliers. Now, you've gone from one single rental unit to managing over $2 billion in assets. What were some of those force multipliers that made that type of scale possible for you?
We got ourselves out of the business as soon as possible, right? Like in the early days, I mean, I can remember getting on those property management weekly calls and could do it. I've been doing real estate since 2009 with a property manager telling them what to do. And then the next week asking them why they didn't do it and trying to get a plan to hold them accountable. But I'll be honest, I was an engineer. I was not a property manager standing at the desk of the leasing office for a decade, and that was kind of where when we went over $1 billion of assets, that was kind of where we started to realize, or we had that's why we take asset management fees, right? So we can hire the right staff to pay these real operators, these asset management teams to kind of manage this stuff. I can remember, very, early on in the transition, there were things that they caught on to that we would just never know. So there's a big difference between somebody running an apartment complex who still works his IT job on the side, that he cares a lot and he's at the property every day, but they just don't have the pedigree right? Like, I'm not going to tell somebody that they can be an engineer by just reading a book and doing it, right? It takes years of experience and mentorship. And same thing with being a doctor. And I certainly think the same thing about being that poor leasing agent in the office trying to lease people up.
So it sounds like people, getting the right people. We were kind of going on that theme of the right partners, but also the people under that. You have management fees, so you can hire the right people. But I think even higher than that, I don't want to miss that, is to say, get out of the business as soon as possible. Hire those right people so that you don't have to keep stepping in. And that's scale.
Yeah. I'm pretty transparent with, my investors and our group. And I've always said, look, I'm just a dumb real estate guy. We are just sort of the kooky entrepreneurs who started this, right? Like the risky years were in the beginning, right? When we didn't really know what the heck we were doing. Like a lot of operation, they don't teach operation. You just kind of learn by doing after a while. When we started to hire it out, I think that's when we really started to realize, wow, what we were missing. Because then we got the pro in there, and we're able to watch over their shoulder. And of course, it takes a little bit of learning curve to manage the professional manager too. That was where we really started to build more of a business over this.
And how did brokers tie into that? Did getting into broker networks, I've had other folks on the show that talk about the importance of that. Did you find just getting close to that deal flow and getting into that broker network was a really a force multiplier for your scale?
Once the brokers know that you're a serious contender, the deals start to kind of go to you. We got lucky that in 2020, they had that pandemic thing, right? That really threw a wrench in everybody's wheelhouse, including the institutions that typically buy a lot of stuff. So they pulled back, right? Because there was a lot of uncertainty. We kept powering forward, and we for a while there we were kind of getting fed the best deals because there was no competition. And that, I think, for us in our growth journey, that was very pivotal time to get established. But brokers are motivated by people who can close, and they're going to keep feeding the hot hand. For a guy listening, getting started, that's not really useful practical advice. It's kind of like, look at me, 90-90 boo-boo in a way. But yeah, that's, if anything, that's a motivation, right? You got to just keep at it. Business development, talking to brokers before you have a track record, let them know that you're serious and not just another unsophisticated investor from California who's remotely investing in these properties out in Texas, not even visiting the properties, not even going on the tours. Like a lot of these brokers, they'll filter a lot of looky-loos. Like, hey Ryan, are you going to be at the property tour this week? If they're not, not even going to look at their offer.
Yeah. So you really got to get in with them, build that relationship, and show them that you're a contender. Like you said, I love that phrase. So what's one hidden cash flow tactic that you like to use that most people don't really hear about?
I mean, I think when people follow me, you look at the apartment investing and now private equity, I think you might be seeing sort of the tip of the iceberg. Before the recent correction, I was maybe personally 80 to 90% of my net worth in commercial real estate, which apparently you're not supposed to do that, right? Just have some diversification. Of course, everybody's different, right? But, I think just me learning, I'm sort of a student of the game myself, learning that, what is it that the wealthy, how they're structured their asset allocation mixes, what I'm keep coming back to is this concept of barbell strategy. I inherently do a lot of more risky things, right? That's what alternative investments are. They're riskier. I do think that it's good risk adjusted returns, and that's why I do it, right? And the fact that, I can sort of somewhat control my own destiny, with renovating units, that type of stuff. But make no mistake, I am balancing this out as a barbell is weighted evenly with, much more safer things like life insurance. I would consider things like T-bills like that too, right? So a lot of, and some of my investors, they really like closed-end funds. There's a whole topic on that world. So, that's where I would say, maybe learn about the two sides of the more stable, secure stuff, maybe even debt products, right? Debt funds, private credit to sort of complement the more alternative investing side.
Mm-hmm. Now you mentioned something I never heard of when we were talking offline. It's something called a lazy 1031 exchange. Maybe you can walk me through a little bit on that cash flow tactic. Yeah.
So a very common situation that we see. In fact, it happened to me, right? When I was coming into this world, I was going into these syndications. They invest in real estate, but they're not like kind of exchanges, right? You're not going from real estate. I had my 11 single family homes. You're going from, it's not going real estate to real estate. You're investing more of in a security fund kind of format. So, you can't do a 1031 exchange. I mean, you can, but nobody's going to allow you in unless you do what's called a tenant in common or TIC and bring in more than like $1 million. It's not worth the legal headache. Just using myself as an example, I think one year I sold 7 single family homes and I had a $250,000 capital gain. But that year prior to that, and that year I was investing in a lot of these deals where, you do cost segs, you get bonus depreciation, and you kind of stock up your passive activity losses. If people are kind of curious how much they have, especially if they've owned past real estate, I think that's the 8582 form, passive activity loss. I honestly don't know how to read it today. Maybe just throw it into ChatGPT and ask how many suspended passive losses I have. But, that's what you pull up as a investor if you don't use it, right? I know some investors like to do real estate professional status and use it to drive down other income. But if you don't do that, your passive losses from real estate just sort of go unused until you activate it and use it for other capital gains. So yeah, that's what I did. I sold my properties, had a capital or gain of and depreciation recapture of 250, but I must have had like $300,000-$400,000 of suspended passive losses. So I used that to offset it that year. And that's what we kind of loosely call, it's not an official term, but we kind of call that the lazy 1031 exchange. Being able to front load some investments, get some passive losses, and use that, in the same calendar year to offset the gains.
Brilliant. Speaking of losses, those can happen, right? Even if you do everything right. What's one of those things that you do to stress test your portfolio for those downturns or black swan events? What are some of those things that you do?
Yeah. So going back to those, those three things I was mentioning at the top, right? Like the reversion cap rate. You don't know, you have no control over the market. Multifamily real estate, just high level usually trades between like a 4 and a 6 gap. When you have good prices and the market's down, it's trading at a 6 gap. When things are hot, frothy, and probably a good time to sell is when things are trading at a 4 gap. You try and add value to properties in that time, right? To, make money on the value add that you're doing. But essentially, markets, just like stock markets, go up and down in a market cycle. Some would say anywhere from 6 years to this past market cycle is very long. I think it's like almost a dozen years. So, when you underwrite properties, you try and account for the market to be either straight line or get worse, to try and account for this. Yeah. And that's where you can, if you do it right, you can come out ahead and, blow projections out of the water. But when things don't go to plan, I think that's when you're a little safer, right? And, going to the occupancy, right? You don't know, like right now, there's a lot of new supply hitting the market from a lot of new properties being built a couple of years ago. So occupancy isn't as strong as it was a couple of years ago. And that's why rents are stagnant to some places down 1% or 2%. And that'll normalize out, right? As most things do, that's a market cycle too. But that's why you don't underwrite your property to hum along at 95% occupancy and everybody paying too.
Okay. One of the things, and I'm curious if you've done this as well, in say private equity, real estate, anything with assets, you're acquiring things, not just paper, but some strategies that people will do is we'll say, well, actually, we will push a lumpy acquisition cycle. So it's not sometimes a smooth acquisition cycle is, right, 3 homes a year, 3 companies a year, or 30, whatever that is. Other ones are saying, we're going to stagger that. So we'll say, we're going to raise a bunch of money. We're going to go buy 20 properties, and we're going to rinse and repeat every 4 to 7 years. So sometimes a stress test is to say it's what I call like a modified dollar cost averaging. Dollar cost averaging, obviously, you just keep purchasing every paycheck you get, throw some money in the stock market. It's typically where you learn that principle. But you can do that to say every 4 years, we're going to buy 8 companies in this sector or 12 certain properties in this particular region. Do you do anything like that as far as helping to protect investors, stress test your portfolio? Do you do any of that dollar cost averaging or staggering acquisitions?
Yeah. I mean, we always try to be investing, and we try to, I've kind of succumbed to feel that I don't know when the top or the bottom of the market is. I just know that at any one time, like try and do an acquisition every quarter, right? And just trying to find the best one possible. Now you may unfortunately invest at the peak of the market, and you can't do that, right? And sometimes people shoot themselves in the foot, right? And they never get involved, and they lose out. Like, I mean, in apartment investing, that was 2016 and 2018, and 2020 to 2021. That was a great time to have the exposure. Most people talk about negative exposure, but if you're constantly like finding a way to shoot yourself out of a deal, you're losing out on that positive exposure. So all that to say, again, I don't know when the top or the bottom of the market is. I just want to be going into the best deals that I'm sourcing at that time. And we roll with that and have, to what you're saying earlier, try to diversify over a 4 to 7 year period. Knowing maybe pessimistically that I will have losses. There will be a point that I will be investing at the top, but have the confidence that if I do diversify over a 4 to 7 year period, that 1 or 2 years will be a word of pain. But my other, 4, 5, 6 years will be good winners end of the day. No different than when I owned single family homes, right? Sometimes I would, a lot of times I would lose money on 1 every 3 house because of something happening at that one property. But you have a big enough portfolio where you can hit some steady state in there, you'll be positive. Won't be as, substantial as what you thought it was or what you think it's going to be. But that's how we're going for. It's like, dollar cost average, the ups and downs. And, sometimes you run into this, when I was in single family homes, and that was probably what made me get out of it. It was like, man, somebody just stole my HVAC, like $5,000 right there. And I'm like, well, that was the cash flow for like 1.5 properties for an entire year. And I'm like, oh, man, somebody ransacked my property. It's like 10, 15 grand, right? Like and I'm like, okay, I'm not even going to do the math in my head. That's just going to make me depressed. You ask the question like, what are we doing this for again? Like, but yeah, you just stay the course, right? Have that stoic attitude that, across your large portfolio, especially again, highlighting again along that longer time horizon, you should come out ahead. No guarantees. Nothing is guaranteed in investing, but you should come out ahead if you diversify yourself enough in good deals.
Brilliant. We talked about the wealth elevator early on, and that's a bit of your framework and a lot of what you do to help people. And we're kindred spirits that way is we just like to help. What's one thing that people can start to focus on if they want to move up just one floor on that wealth elevator? What would you recommend they start doing today?
If you're a guy who doesn't even make $50,000 a year, as Grant Cardone says, you got to work on your income. You're not gonna like save $5 per latte and get your net up that way. So in the book, we define the basement level, first floor, second floor, which is now you're getting into accredited investor status, third floor, fourth floor. First step is figuring out what you are at and then kind of concentrating on what's the tasks before you. When I graduated college, the name in the game was just buying little rental properties, building my net worth. I eventually graduated to the second floor, which is syndication private placements. And then I got into this world of other accredited investors and started to learn what the heck people did after the third floor and, $50 million, $100 million net worth in the family office land. I do think that exposure is important for people even on the first floor. But again, I think it's maybe all too often people put the cart in front of the horse, I guess. Go read the book, right? Understand what's beyond the third floor. But I think the task at hand is figure out where you're at today and focus on that.
Brilliant. That comes into a framework of just a little self-awareness. And a big part of this is understanding where you're at. And just for my own journey, if I can add a candle to your bonfire, is I come up with the 3 most valuable assets in your possession: your reputation, your relationships, and your results. And so a great place to focus on that is building out those things: your reputation, your relationships, and your results. Then once you have that, it becomes a lot easier when you're ready to go out to market, start building, do your first deal, your first fund, your first partnership, whatever that might be. Is if you have a decent amount of reputation, relationships, and results, you don't have to be perfect, but focusing on those helps money and deals come to you. And so starting out a lot of times, like you said, is just know where you're at and focus on those big, we'll call it, you didn't use these words, but big rocks, right? Instead of trying to save $5 for a latte, it's fine. Like, I get it. Maybe that's more mindset than actual impact. But you really want to be looking at what are some of the biggest gaps. And we've talked about that before, is just understanding like, where is this not matching for me? I want to be an investor. I want to invest in real estate. I want to be like Lane when I grow up. How do we do that? The answer is you really need to focus on some maybe better reputation, right? You're a guy that studies his butt off. He works hard. He knows how to finish. He knows how to close. Maybe it's get out there and start introducing yourself to people who are in the game and maybe get some results. Show people you know how to get things over the line, right? Even as an engineer, there was some powerful things that you were able to, I'm sure, to bring forward into a lot of your real estate career. So my final question for you before we wrap things up is, what's one myth about passive income that you wish you could erase from everyone's mind?
Yes, people think passive income, you do a bunch of stuff and it rolls in. I always say easy come, easy go. sometimes these passive income sources are fleeting. I know you worked a lot in the oil fields, right? You get a gusher, but it doesn't last forever. It ain't forever. Real estate is the closest thing that keeps going on in perpetuity in a way, but there's a spectrum to this, right? You make a referral for in a digital marketing agency format, right? Like for all we know, your referral compensation could only last for 6 months. You get a oil well, that those things usually 4-6 years or something like that, right? And then it kind of dissipates off the first year or two. Certainly like you are going after this esoteric idea of passive income, but it requires capital if you really want lasting things.
Okay, so capital is the main one.
And how do you get capital? Well, you create value in the world, right? Like we rinse, wash, repeat, renovating units or developing units or value-adding businesses, right? That's how we create value. That's how wealth comes to those people who create value in the world, and then that will give you a boatload of capital for you to convert it into passive income. So some people, when I was first working as an engineer, all I wanted was passive income because my short-term goal was to quit my day job, right? Replace my income. When I started to get to the third floor of the wealth elevator and greater and started to interact with cats like that, I realized that they didn't care what money came in on a quarterly or monthly basis. They got away from that cash flow focus. Why? Because they had a lot of money. They didn't need it. They had a lot of cash flow too, right? So they're abundant in it anyway. What the emphasis was the growing their damn net worth, that capital portion, because they knew that they could convert that to cash flow very easily. You asked me, what would I rather have? $200 a month or $2,500 right now? Of course, you got to do the math, right? What's the interest rate, right? But I would take $2,500 right now, all day, every day. I would take $2,000 right now, all day, any day, right?
Yeah, brilliant. So cash up front. I love it. So before we wrap things up, where should people go if they want to follow the blueprint that you've built? Where can they go to get more information and learn more? Yeah,
they can go on Amazon. The book is called The Wealth Elevator. If they pick it up and then shoot us an email, we'll hook them up with the audiobook version just in case they're like me and can't read too well. And like to listen to things, and then or the PDF, they're a Kindle person. Team at thewealthelevator.com. Just let us know you picked up the book. If any accredited investors are out there, want to jump on a call, get to know each other a little bit better, my email is lane@thewealthelevator.com.
Great. So mention making billions. You mentioned that, go on that email, and then they can get some of the audio book as well. So I love that, man. So just to wrap things up, make sure that you understand building the right team, the right partnership. It matters. Find those frameworks. Make sure you understand debt and leverage, and also seek better understanding of underwriting. You do these things, and you too will be well on your way in your pursuit of making billions.